Hey traders, and welcome back to another episode of Smart Risk. Most traders lose money not because they're lazy, but because they don't have a trustworthy, rules-based setup. And without a solid setup, trading isn't trading. It's just gambling. That's why today I'm going to break down one of my most powerful smart money concept strategies. A setup that combines liquidity sweeps, order blocks, and fair value gaps into a single trading model to create A-plus trading opportunities. And I won't just explain the theory. I'll walk you step by step through how to apply this strategy directly on your charts. By the end of this video, you'll have a clear, actionable roadmap to confidently use this setup in your own trading. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. So let's get started. This powerful setup is built around revisiting a swept liquidity area and the classic fair value gap. Combining these two concepts creates a high-probability trading model that performs well in both bullish and bearish market conditions. In the bullish scenario, this setup plays out when price returns to a zone that already swept sell-side liquidity of a key level before, such as the lows of a key demand zone, a major low, or a cluster of lows, and then shows a clean rejection. Once price taps into the liquidity sweeps order block, the price usually reverses sharply and continues in the upward direction, resuming the bullish trend. On the flip side, in a bearish market, the exact same concept applies, just in reverse. Here, the setup plays out when price revisits an area where buy-side liquidity has already been swept, such as the highs of a key supply zone or a cluster of equal highs. A swift rejection from that level sets the stage for a drop, confirming the continuation of the bearish trend. Now you might ask, what makes this setup powerful? The logic behind this setup is simple, but very strong. Smart money usually pushes price near the key areas in order to manipulate the market and traders to generate enough volume for itself to execute its orders, and usually it does that with a quick move that sweeps below or above a key level, followed by a sharp and quick reversal move in the opposite direction. So, these zones are where smart money first enters their positions. They're manipulation areas that form before the main institutional orders are executed. That's why they carry so much weight. Price tends to respect them. So, when price comes back to these zones, institutions often step in again to defend their positions or initiate the remaining portion of their trades. That's exactly why we wait for the price to revisit these zones. To get the best results with this trading plan, you'll need to work across two different time frames. First, use a higher time frame to analyze overall market conditions and to spot liquidity sweeps along with the order blocks tied to them. The most effective higher time frames for this setup are the 30-minute and 15-minute charts. Then, once you've identified a potential setup, zoom into a lower time frame, like the 5-minute or even the 1-minute chart, to look for confirmation signals and precise entry points. Here's the breakdown. If you're analyzing on the 30-minute chart, drop down to the 5-minute chart to confirm reversals and find your entry. If you're working with the 15-minute chart, then shift to the 1-minute chart for confirmation and entries instead. The beauty of this setup is that it works effectively in both scenarios. It's just about choosing the time frames that fit your style and sticking to them with consistency. Now, let's break down the details of the first trading setup. In the bullish scenario, the first step is to spot a valid liquidity sweep on a higher time frame, like the 30-minute or 15-minute chart. You're looking for the price to take out a key level, immediately reverse, and then confirm with a break of structure. Once that happens, you need to mark out the order block that initiated both the liquidity sweep and the break of structure. That's your higher time frame point of interest, and more often than not, price will revisit this block, acting as a demand zone where smart money steps back in. After marking the block, the next step is to wait for the price to retrace into it. That's where your trading opportunity lies. Now, when price comes back into your order block, you have two entry approaches depending on your style. Conservative and aggressive entry. Let's start with the conservative entry method. Once price returns to the higher time frame order block, we zoom into a lower time frame, like the 5-minute or even the 1-minute chart, and look for signs of reversal. This could be a market structure shift or a clear change of character, which gives us our first layer of confirmation. Now, once that structure shift is confirmed, and we expect the price to move higher, the next step is to look for a buying opportunity. At this stage, we focus on spotting a bullish fair value gap that forms within the market structure shift leg. These zones often act like magnets, pulling price back in before it continues upward. To execute the trade, we place a buy limit order at the midpoint, or 50%, of the bullish fair value gap on the lower time frame. For the take profit, we target the higher time frame buy-side liquidity, which gives us a precise and high probability setup. However, in the second entry method, the more aggressive approach, once the price taps into the higher time frame order block, the next step is to zoom into the lower time frame. Here, we're looking for a violated fair value gap that transforms into an inversed fair value gap. That's your first confirmation. Once this inversed fair value gap forms, it's likely to hold as a new support zone, giving us a solid entry point for a buy position. If a market structure shift also occurs at the same time, that adds another powerful layer of confluence, strengthening the setup. With these confirmations in place, we can expect the price to retrace into the inversed fair value gap before continuing upward toward the next buy-side liquidity. At this stage, you'd place a buy limit order at the midpoint of the newly formed inversed fair value gap, with your take profit targeting the nearest higher time frame buy-side liquidity. The same concept applies to the bearish scenario. One important tip: if you're trading with the 30-minute and 5-minute time frame combination, both conservative and aggressive entries work well. But if you're working with the 15-minute and 1-minute combination, the aggressive entry approach tends to be more effective. Now let's put everything together and go through a real chart example to see exactly how this strategy plays out. On the screen, we have the US dollar Swiss franc 1-hour chart. As you can see, after price swept the sell-side liquidity below this 1-hour swing low, it immediately returned back into the range, quickly shifting direction and pushing to the upside. If we zoom into the 30-minute time frame and look more closely, we can see that after forming a valid liquidity sweep, price also created a bullish break of structure by breaking and closing above the most recent swing high. So, everything we were looking for is here. A valid liquidity sweep, followed by an immediate reversal in the opposite direction, and a break of structure on the 30-minute chart. The next step is to focus on the origin of this bullish expansion, the exact move that caused both the liquidity sweep and the break of structure. For that, I'll highlight this down close candle, the opposite color candle, which forms the 30-minute order block and has the potential to reverse price. This leaves us with a fresh, unmitigated demand zone. And this is exactly where we want to keep our eyes. It's an ideal area to look for long opportunities if price pulls back into it. Once we've identified the higher time frame order block, the next step is to wait for the price to tap into it. Now let's play the chart forward to see what happens. As you can see, price pushed downward and eventually taps into the zone and shows rejection. Next, I zoom into the lower time frame, in this case, the 5-minute chart, to closely monitor price action within the 30-minute order block zone, and look for any signs of reversal and a suitable entry point for a long trade. Now, on the 15-minute chart, you can see that after price tapped into the higher time frame order block, it reversed and formed a market structure shift by breaking and closing above this 5-minute structure. This tells us that the selling momentum is fading, and buyers are stepping back in. Once the bullish market structure shift is confirmed on the 5-minute chart, we expect the price to push higher. The next step is to look for an entry point for a long trade. Now, if you look closely, you'll notice that price has formed a bullish fair value gap within the market structure shift leg. This area often acts like a magnet, drawing price back into it before continuing to the upside. With all the rules and conditions now in place, I'm taking the conservative entry approach, setting a buy limit order at the midpoint of that 5-minute bullish fair value gap, and targeting the most recent 30-minute buy-side liquidity as my take profit. Now, let's play out the trade and see what happens. As you can see, my long order has been triggered, and then price shifted direction, pushing higher exactly as expected, and eventually hit the TP. Now let's move on to the next real chart trade example. Here we have the Euro-dollar 30-minute chart on the screen. As you can see, price swept the buy-side liquidity above this swing high and then immediately reversed direction, dropping back below the swing highs range and pushing to the downside. Now, if you look closely, you'll notice that after forming a valid liquidity sweep, the price also confirmed a bearish break of structure by breaking and closing below the most recent swing low. So, all the criteria we were looking for are in place. A valid liquidity sweep, an immediate reversal in the opposite direction, and a clear break of structure on the 30-minute chart. Next, I'm going to highlight the 30-minute order block as our point of interest. Specifically, this last up-close candle before price initiated the bearish expansion move. This gives us a fresh, unmitigated supply zone. And this is exactly where we want to focus, because it's an ideal area to look for short opportunities if price pulls back into it. Once we've identified this higher timeframe order block, the next step is to simply wait for price to tap into it. Now, let's play the chart forward and see what happens. As you can see, price pushed higher and tapped into the 30-minute supply zone. At this point, I zoom into the 5-minute chart to closely monitor the price action inside the zone. And here's what we notice. Once price tapped into the higher timeframe supply, it rejected and also violated this bullish fair value gap by breaking and closing below it, which formed an inversed fair value gap. This inversed fair value gap is now more likely to hold and act as a new resistance level, giving us a solid entry point for a short trade. From here, the expectation is simple. Price will retrace into the inversed fair value gap before continuing its move to the downside. With all the rules and confirmations now in place, I'm going to take the aggressive entry approach, setting a sell limit order right at the midpoint of that 5-minute bearish inversed fair value gap, and targeting this swing low that is formed just above the gap. Now let's play the chart forward and see how it unfolds. As you can see, price pushed a bit higher, triggered our sell limit order, then quickly reversed its direction and drove down with strong bearish momentum, perfectly hitting our take profit. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.